Welcome back to Investing Talk Podcast.
Today, we're looking at Carvana.
As usual, before we start, subscribe, like, and comment to this video to support the show, because today we have to talk about something that is driving me absolutely crazy.
Yeah, it's definitely a massive contradiction. Maybe the biggest one we've seen in the market all year.
Without a doubt, we are looking at a situation that it breaks standard market logic.
It really does, because you have a company that just posted what looks like an absolute blowout quarter. I mean, truly massive, record-breaking numbers.
Right.
And yet, the market reaction was just violently negative.
Violent is the exact right word for it. For anyone who missed it, we are talking about Carvana stock falling 10% in pre-market trading on February 19th, 2026.
Which is wild.
It is, because usually, when a stock drops 10% overnight, you just assume they completely missed earnings, or the CEO quit, or there's some massive scandal.
Yeah, or the factory burned down.
Exactly. But here, the headline numbers look stellar. It's confusing a lot of people right now.
It is the textbook definition of a disconnect. And that really has to be our mission for this show. We need to figure out what is actually going on under the hood.
Right. Is this what do they call it, a capitulation sell-off?
Yeah, basically a panic moment that is offering a golden buying opportunity for you if you're paying attention.
Or, on the flip side, does the market see a structural flaw, a real crack in the foundation that those pretty headline numbers are just hiding from us?
Exactly. Is this a massive discount, or is it a value trap?
So let's stop guessing and actually unpack the fundamentals here. We have to start with this strong revenue beat for Q4 2025 that everyone is whispering about. Walk me through the top line.
Sure. So ideally, in a growth stock, you want to see growth. And Carvana delivered that in spades. Their reported revenue came in at $5.6 billion.
Okay, $5.60 billion. And what was the street expecting?
Well, Wall Street, the people paid to guess these numbers, they were only looking for $5.27 billion.
Oh, wow. So that isn't just a rounding error.
Not at all. That is a significant, undeniable beat. And if you zoom out and look at the year-over-year growth, we are talking about 58.0%.
58% growth for a company of this size? I'll admit, that is impressive. Because usually when you get to the billions in revenue, growing that fast is like trying to turn a cruise ship like a jet ski.
It's incredibly hard to scale revenue at that tier.
But you know the old saying, revenue is vanity, profit is sanity.
Right.
So the number that really made my eyes pop out of my head was the earnings per share.
It was exceptional. I mean, this is where the whole blowout narrative comes from. Q4 2025 EPS came in at $4.22.
Wait, pause right there. $4.22. I want to make sure you all understand the context of this. What were the analysts actually expecting them to report?
They were expecting $1.13.
That is just wild. That's not a beat, that's a demolition.
Yeah, it's a 273.45% beat.
How do you even miss a model by that much? The analysts must be scrambling.
It definitely caught everyone off guard. And just to give you some context on the turnaround here, because memory is very short in this market, if you look back at Q4 2024, just a year ago, their EPS was only 56 cents.
Oh, wow.
Yeah. So we aren't just seeing a little seasonal bump. We are seeing a fundamental shift in their ability to actually generate profit.
Okay, so that sounds like a massive victory lap. They should be popping champagne over there. But, and I'm the skeptic here for a reason, if the numbers are that objectively good, why did the stock drop 10%?
Wow.
Because I was digging into the report, and it feels like the party completely stops when you look at the adjusted EBITDA. There was a miss there, wasn't there?
There was a miss, yes. And you're completely right to point it out. While the EPS was huge, the adjusted EBITDA, which is basically their core operational earnings, before all the fancy accounting adjustments that came in lighter than expected.
And from what I saw, it seems like that miss was driven by lower retail gross profit per unit, which is the metric that keeps me up at night regarding Carvana.
It's definitely the key metric for their unit economics.
Right, because when you sell way more cars, but you make less profit on each specific car, that usually screams pricing power issues. It tells me they might have had to run heavy promotions or drastically slash prices just to move that metal. Is that what happened?
That is a very fair critique. It's the classic empty calories argument.
Right.
Are they just buying revenue by sacrificing their margin? But honestly, I think you're missing the forest for the trees here.
How so?
You have to look at the operational leverage, look at the net margin improvement overall. That's up to 6.92%.
Okay, explain that for someone who isn't a CPA. Why does that 6.92% actually matter if the per unit profit is down?
Because it proves that as they get bigger, they get more efficient on a corporate level. They're getting better at running the machine itself. And more importantly, you have to look at the return on equity, the ROE.
Okay, what was it?
It hit 61.70%.
61.70%.
Yes, that is a sign of truly exceptional capital efficiency. You rarely ever see that kind of number in retail or the automotive sector.
That is extremely high.
It is. It suggests that they aren't just growing at all costs anymore. They are actually making real money on the equity deployed. They're turning every dollar of investment into over 60 cents of profit. That is elite territory.
I suppose that's the primary argument for this being a true profitability inflection point.
Exactly.
But before we move off the business model itself, we need to talk about their competitive moat. Because for years, bears have just said Carvana is a used car lot with a flashy website. Do they actually have a real competitive advantage, or is this just a digital facade?
I'd strongly argue they have a double mode at this point. The primary one is their operational scale and logistics. Everyone jokes about the giant nationwide vending machines.
Yeah, the big glass towers off the highway. They look cool on Instagram, but are they practical?
They aren't just marketing gimmicks. They are highly efficient fulfillment centers. If you think about the logistics of a used car, it's a total nightmare.
Right, you have to buy it, inspect it, recondition it, and then ship a 2-ton piece of metal across the country.
Exactly. Most competitors struggle to do this profitably at scale. Carvana's vending machines serve as vertical warehouses that drastically cut the cost of that last-mile delivery. That infrastructure is incredibly expensive to build out, which keeps competitors out of the space.
That is a fair point. It's hard for some new tech startup to just replicate a nationwide physical logistics network overnight. You can build a slick app in a day, but you can't build 30 glass towers and a massive transport fleet in a day.
Precisely. And the secondary moat is their data. They have processed so many transactions now that their underwriting capabilities allow them to price risk significantly better than your local dealership can.
So they have an information advantage.
Huge advantage. They know exactly what a 2021 Honda Civic in Ohio is worth, down to the penny. And while I know you're worried about the lack of specific guidance for 2026, management did project significant growth in retail sales and adjusted core profit for the full year.
Yeah, but significant growth is a bit vague for my taste. It sounds like corporate speak from we're not totally sure yet.
It's cautious, yes.
But let's use a verbal bridge to pivot to the charts and price action, because we need to see what the market is actually doing with this information.
Let's do it, because the chart is telling a very different story than that glowing earnings report.
It looks like a crime scene, honestly. The damage report is nasty. The stock is down 22% year to date. We are trading near $361 right now.
Yeah, it's taking a hit.
And that 10% drop on February 19th, that feels heavy. It really feels like the market was incredibly disappointed by that vague guidance we just mentioned.
It was absolutely guidance disappointment. Wall Street hates uncertainty more than anything else. But here is the key takeaway for you. It wasn't fundamental rot.
Okay, that's a massive distinction.
Right. When you look at the technicals, this setup screams mean reversion.
Mean reversion. Let's unpack that concept for a second. You basically think the price has snapped too far in one direction, like a rubber band.
Exactly. Think of the stock price like a rubber band attached to the company's actual intrinsic value. Sometimes fear pulls that rubber band way too far down. But the laws of financial physics say it has to snap back eventually.
Right. Eventually reality sets in.
Yes. Look at the disconnect we just talked about. You have a 273% EPS beat, and the stock goes down 10%. That simply doesn't make sense mathematically unless the market is just panicking and overreacting to the lack of forward guidance.
So you think the market is just purely emotional right now, but am I the only one seeing this danger? Who else is still bullish after a violent drop like that?
Honestly, pretty much everyone who matters in the analyst community. Despite the drop and some minor target cuts, major analysts still see significant upside from this $361 price point.
Who specifically?
Well, Wells Fargo is at $425 with an overweight rating. Bank of America has a buy rating at $400, and BTI is sitting all the way up at $455.
Wow. So BTI thinks there's almost $100 of upside per share from right here. That is not a small margin of error.
No, it isn't. The institutional thesis on the street hasn't broken. They view this as a temporary stumble regarding guidance, not a fall off a cliff.
One thing I noticed on the technical side, though, is the implied volatility and the sheer volume. Carvana is the top trending ticker right now with extremely high message volumes on all the trading forums.
It's very noisy right now.
It is. And usually when everyone is shouting about a stock online, it's not exactly a calm water situation. It feels chaotic.
It is chaotic, but chaos can be very useful if you know how to read it. I interpret that high volume as retail capitulation.
Capitulation. That's essentially a fancy finance word for giving up, right?
Basically, yeah. When you see extremely high volume on down days, lots of angry messages online, people swearing they're selling their shares and never coming back, that often signals the total exhaustion of selling pressure.
Meaning everyone who wanted out is already out.
Exactly. All the people who are going to panic sell have already hit the bid. Once the sellers run out of shares to dump, the only way for the price to go is up. That kind of emotional washout usually precedes a very sharp reversal.
Okay, let's use a verbal bridge to move over to market perception and sentiment analysis, because that retail anger you just mentioned, it is very real out there.
It is incredibly real.
If you scan the news cycle and retail sentiment, it's just ugly. The headlines are all screaming words like plunge and profit metric misses, and then you pile on the macro jitters affecting everything else.
Yeah, the macro environment isn't helping.
Not at all. We've got U.S. and Iran tension escalating again. We've got Walmart putting out caution warnings about the health of the consumer. It's a very bad cocktail for a consumer discretionary stock. On social platforms like StockTwits, retail sentiment has completely flipped to bearish. People are genuinely scared.
Retail is scared, yes. They're reacting entirely to the scary headlines and the red on their screens. But let's look at who isn't scared. This is the part that I think is the single most telling signal in this whole setup.
Okay, who isn't scared?
The institutions. Specifically, look at the institutional flow right now. Aberdeen Group Plank has actually grown its position during this exact period of volatility.
That is really interesting. So the little guy is panic selling at a loss, and the big funds are quietly buying.
That is the classic divergence we look for. Smart money versus dumb money. While the retail investor is panic selling because of a scary headline about a minor EBITDA miss, the smart money is stepping in and aggressively buying the dip.
Because they're looking at the actual fundamentals.
Right. They are accumulating shares at these heavily discounted prices because they are looking at that 61% ROE and that 58% revenue growth. They know the underlying engine is humming.
So if we had to score the sentiment overall, it's essentially a split decision right now.
We definitely have to agree that the short-term sentiment score is strongly bearish, mostly due to this retail capitulation event. The crowd just hates it right now. But the long-term analyst ratings, they stubbornly remain buy or overweight.
And it's worth noting that those analysts maintained those bullish ratings despite the total lack of specific 2026 guidance.
Yes.
They didn't just bail because management got a little quiet on the specific numbers for the next 12 months. That says something.
It's a massive vote of confidence. It means they fundamentally trust the management team to navigate the year, even without a specific public roadmap being handed to them.
All right, but we can't just sit here and paint rosy pictures all day. We need a verbal bridge to execute a deep dive into the risks.
Fair enough.
Because there are some very real red flags that you need to be aware of if you're looking at this stock, and I do not want to gloss over them. Let's look at the bear case.
Let's do it. What's the biggest risk in your eyes?
Risk number one is absolutely that guidance void we keep mentioning. Management, point blank, refused to provide specific 2026 guidance ranges.
It definitely creates a lot of uncertainty.
It creates fear. The fear is, does management know something bad is coming down the pipeline? Are they hiding a severe deterioration in margin sustainability?
I see where you're going with this.
Because if Q1 2026 results, which are expected on May 6th, if they show severe EBITDA pressure, this stock isn't going to just sit at 361. It could easily drop another 15 to 20%. Why wouldn't they just give us the numbers if they were actually confident?
That is a completely valid risk to highlight. However, I'd strongly argue that the margin pressure we saw in Q4 is cyclical, not structural.
Meaning what, exactly?
Meaning it's just about fluctuating used car pricing, which bounces around based on supply and demand in the broader macro economy. It's not a structural flaw to Carvana's business model. They are still selling cars incredibly efficiently. The wholesale market price for those cars just dipped a bit during the quarter.
So you think they're just waiting for buyer visibility?
Exactly. Management likely wants to see how the spring selling season plays out in the first quarter before locking themselves into a hard number that they might barely miss.
Okay, playing it safe. I can accept that. But what about risk number two? The Hindenburg shadow.
Right. We absolutely have to address the elephant in the room.
Hindenburg Research, the notorious short seller firm, has made some very aggressive allegations regarding accounting manipulation at Carvana. Specifically, they pointed to $800 million in undisclosed related party loan sales from January 2025.
Those are serious allegations. Anytime you hear the words undisclosed and related party in the same sentence, your ears should definitely perk up.
Exactly. It sounds like straight up self-dealing. Retail investors are reading this report and worrying about massive hidden debt and a total lack of real operating cash. They worry the books are essentially cooked, or that Carvana is moving bad auto loans off the books to insiders just to make the quarterly numbers look better than they are.
Look, Carvana has aggressively rejected these claims as entirely misleading. But more importantly, you have to look at the hard financials we just discussed. A 61.70% return on equity, a rapidly stabilizing balance sheet.
You don't think a fraud could fake those?
Not at this scale. These are not the metrics of a company that is insolvent or faking its core business. You can massage earnings with accounting adjustments for a quarter or two, but you cannot fake actual cash flow and operational scale forever. The underlying business is generating very real returns.
So you think the upcoming 10K filing will clear this whole mess up?
I really do. Once the fully audited financials are out, completely transparent for everyone to read, I think those Hindenburg fears are going to largely dissipate. A transparent 10K usually acts as sunlight, and sunlight is the best disinfectant for short seller reports. I believe the company is significantly healthier than the allegations imply.
All right. We need to use a verbal bridge to move to the final decision. We've looked at the massive earnings beat, the confusing stock drop, the technical disconnect with mean reversion, and the very real risks regarding transparency and short sellers.
We've covered a lot of ground.
We have. It is time for the final verdict. Looking at everything, the fundamentals, the technicals, the scary headlines, the Hindenburg report, what is your final bullish score for Carvana right now?
I'm giving it a 7.5 out of 10.
A 7.5. That's fairly high given the terrible sentiment and the scary 10% drop we just saw.
It is high, but my core thesis is that this is a profitability inflection and margin expansion play.
Okay, summarize that for us.
The 10% post-earnings decline is a classic buying opportunity. It was caused by short-term guidance disappointment, not a fundamental failure of the underlying business. The market is punishing them heavily for being quiet, not for being fundamentally broken.
So you see this purely as a massive discount?
Absolutely. It's a clearance sale on a highly efficient, high-growth asset.
So what's the timeline and strategy here? If someone listening wants to actually act on this analysis, what are they looking at?
In the short term, it's a swing trade leading right into the Q1 2026 earnings report on May 6th, 2026.
Why that date specifically?
Because that is the major upcoming catalyst. That is when management will finally provide the missing 2026 guidance. If they come out and validate that significant growth rhetoric with hard, undeniable numbers, the uncertainty completely evaporates and the stock re-rates 20 to 30% higher almost instantly.
And what about for the long-term investor, the person who doesn't want to watch the ticker every single day?
For them, it's a multi-year hold. You are basically betting on their ongoing transition into becoming the highly profitable, undisputed market leader in the online auto space. They are building the Amazon of used cars, and they are finally proving to Wall Street that they can do it profitably.
And your ultimate price target?
We're looking for a return to those high analyst targets. We want to see it grind back up to that $425 to $455 range.
That is a significant upside from $361. You're talking about almost $100 a share in potential gains.
The risk-reward ratio is incredibly asymmetric right now. The downside seems relatively capped because all the bad news, the vague guidance miss, the Hindenburg fear that is already priced into this 22% year-to-date drop.
But the upside?
If they execute on their margins, the upside is wide open.
Well, there you have it. A deeply confusing quarter, a panicked retail market, but potentially a massive opportunity if you have the stomach to handle the volatility. As always, do your own research, but the data is definitely pointing in a very interesting direction today. Subscribe, like, and comment to this video to support the show.
Thanks for listening. We'll see you next time.